Ladies and gentlemen, let's talk about the latest shenanigans by Wall Street and why, once again, corporate America seems to have pulled the exact same trick to trap the economy between a rock and a hard place, a predicament that's been exacerbated by none other than, you guessed it, some questionable policies by none other than the Fed. Yes, we are talking about U.S. banks aggressively slashing interest payments for corporate depositors in light of the latest cuts in federal interest rates. Banks like Citizens Financial, Fifth Third Bank, and even heavy hitters like Wells Fargo are all playing along with the same script. But let's pause for a second and ask ourselves, what does this really mean for the economy, from regular folks to the 1%, from corporate America to the heartbeat of small businesses struggling to stay afloat? Now, don't dismiss this as just some finance talk buried in banking quarterly reports. This emerging trend reflects much deeper economic issues that echo problems lurking closely linked to how banks, businesses, and the government handle monetary policy. So, let's deconstruct it from ground zero. Alright, let's roll back the clock to 2022, when things were running hot. Inflation was spiraling, and the Federal Reserve had no choice but to jack interest rates to their highest levels in more than 2 decades. Borrowing got expensive, but saving actually got a little bit sweeter, at least for a change. Banks, pressured by rising competition, particularly those scrambling at the mid-tier and smaller scale, began offering marginally better rates for depositors, not just retail customers, but also corporate clients swimming in millions or even billions in reserves. This gave those clients an incentive to park their money rather than move it to something more volatile, like money market funds or other investment vehicles. But fast forward to September 2023. The Fed, trying to navigate away from the fears of an impending recession, created by, you guessed it, those very rate hikes, slashes that benchmark interest rate by 50 basis points. It's a move that signals the beginning of a series of cuts, setting a potential downward trajectory toward rates closer to 3% by 2026 or so they project. And now, banks, pressured by narrowing net interest margins, are grasping at any lifeline they can, starting with their favorite first target, cutting down on what they pay out in interest to corporate depositors. After all, why should corporate America get the benefit of high returns when rates are coming down, and depositors are no longer from the once biting, now shivering bunch moving away to money markets? Here's the crux of the matter: when banks cut payments to corporate depositors, make no mistake, it's not doing this to help you or help the economy stabilize faster. This is about profit margins, pure and simple. The banks have identified that influencing corporate deposit accounts offers the quickest and most efficient way to cushion their own profit losses in the interest rate juggling game. As Jason Goldberg from Barclays puts it, we're only in the early innings of this cycle, a telltale sign this trend is just picking up steam. But let's pause here to look at the bigger picture. Cutting interest payments might make sense on the surface for trapping corporate-held cash, but this actually exposes the structural weaknesses of today's banking system, particularly among the country's mid-sized and smaller institutions. Banks chase savings during periods of high rates, but seek to offload the cost burden during low-rate cycles. To regular folks, who hold deposit accounts with minimal returns, this trend only further identifies what has long been a concern: banks are less concerned about depositor welfare and more about short-term survival in a volatile market. Bigger banks like J.P. Morgan and Bank of America, unsurprisingly, are still in positions of strength. According to statistics, they have vast pools of cheap deposits where these institutions don't even pay interest on a sizable chunk of their holdings. For example, about 32% of J.P. Morgan's roughly $1.9 trillion in U.S. deposits don't earn any interest. Quite the luxury, right? Especially when mid-tier or regional players are scrambling to lower corporate rates as quickly as they can before their clients wise up and pull their cash. This strategy highlights how skewed incentives are within the system. Banks like Citizens Financial even go so far as to say they prefer using very, very scientific, behavioral models to somewhat deduce the tipping point at which depositors, corporate or otherwise, will be satisfied enough to leave their money in banks without getting higher returns. Essentially, the banks are wielding psychological games, teasing depositors to see how cheaply they can lock them down. And you thought you were the paranoid one? Now, if you zoom out a bit, the real challenge begins to emerge from this insider power struggle among U.S. banks. Weak demand for loans has hurt interest rates for banks' traditional income sources, and that is a huge red flag for the wider economy. When corporations aren't borrowing and aren't investing in new projects, it speaks to a broad economic hesitation. A sign these entities don't see opportunities worth the added risk tied to borrowing money. This creates a vicious cycle. Corporate clients who once gladly benefited from rising rates are now being pinched by this new cost-cutting atmosphere, leading corporations and businesses to begin reassessing their relationships with banks, pulling reserves into more actively managed assets that grant higher returns. As some banks attempt to hold on to corporate deposits by offering slightly lower rates, others will face higher risks of liquidity squeezes and potential deposit flight. And who will pick up the pieces when some of those institutions falter from mismatched liabilities and payouts? None other than the good old taxpayer, should the government step in to guarantee liquidity, as it has in crises past. Does 2008 ring any bells? The broader problem this creates for the U.S. economy is decreased investment from the nation's biggest job creators, private corporations. If banks are effectively telling corporate depositors, you'll have to deal with lower returns, it increases the cost for businesses sitting on cash reserves to invest in expansion, technologies, or new hires. The recovery momentum slows, and for smaller businesses that rely on these corporate-led expansions for orders and contracts, the situation worsens. Stepping back, you'll nearly always see how corporate decision-making from banks trickles down and affects the broader supply chain. All this posturing leaves the middle class out in the cold. Because as soon as banks see that corporate clients don't need additional lending and the appetite for risk is worn down, it tightens up the rest of the credit channels. So while your big institutions don't have to raise deposit rates for the layman, they also minimize lending risk by tightening the proverbial tap for average consumers, especially homebuyers and small businesses. Small businesses, already facing inflation and rising costs, now have fewer lending avenues. Middle America gets branded with ceremonial rate cuts but without real benefits. What should we be watching out for? 3 implications are unfolding. 1. Corporate withdrawal. As interest rates shrink on corporate savings, expect to see big businesses shift away from placid bank accounts to high-performing avenues like repurchase agreements or short-term commercial paper markets. This could shrink the liquidity pools many smaller banks are clinging to for survival. 2. Increased bank competition. With liquidity squeeze signs starting to build, banks will scramble to undercut each other, putting pressure on weaker players, deepening the fragility of already stressed regional banks. Remember SVB? Yes, echoes of similar risks. 3. Unintended inflation. If larger entities begin borrowing against less liquid assets and start fueling new, asset-driven industries, like green tech, we may see currency speculation or price spikes emerging in unpredictable ways, fueling recently cooled inflationary trends. At the end of the day, banks aren't prioritizing the real engines of the economy: consumers, small business owners, innovators, the middle class. Instead, they're operating reactively within the Fed's haphazard monetary framework. In their desperate push to create profitability, their response has been to bleed out small depositors while recalibrating corporate agreements to squeeze out every last bit of interest differential with little regard for broader economic stagnation. The lesson here is one of misaligned priorities. When banks obsess over immediate bottom lines while policies lack foresight, they simply don't leave room for long-term stability or sustainable growth. So, while corporate depositors may take the initial brunt, the reverberation works its way through the entire economy, straining businesses, banks, and everyday Americans who simply are left waiting for another bubble, another collapse, and another bailout. And who gains? Well, that's still to be determined, but the final cost? Oh, that's practically guaranteed to fall at your doorstep, my dear taxpayers. Let's watch how this plays out, because the early innings already hint at a mess. Cheers to surviving round 2.